Good morning and welcome to another class. In our last class, we actually look at the various forms of consolidation. Having checked our IAS 7 statement of cash flow. From there, we move to statement of profit or loss and mid-year acquisition, where we actually look at the various questions on mid-year acquisition, where we discuss that of the questions of Veda and Mau, as well as the P and S. Today, we shall continue with other forms of acquisition, which will lead us to everything we ever wanted. And we also introduce ourselves to the ratio analysis. And the next class, I said, shall be our concluding part on everything. I believe so much that if you have already missed the class, please kindly do yourself some favor by going through the video that has been furnished on our platform. Then you have your chances to success. Welcome. Let's get started. The question here starts from, this is the financial statement of Super Financial Statement and its subsidiary as at 31st of December 2005 here as follows. We have Super PLC and we have Star PLC. We are given the non-current assets, the current assets, equities and liabilities up to the relevant notes. Now let's get started. Going by the relevant notes, I will start from that. On 1st of July 2003, Super PLC acquired 60% of the equity shares of Star PLC when the equity component and the retained earning of Star PLC stood at $1.2 and $1.5 respectively. The acquisition was through a share exchange of 3 shares in Super for every 4 shares acquired by Star PLC, and promised to pay 146 for 100 on July 1st, 20x15. You are required to calculate the market price per share of Super PLC and Star PLC were 6 naira and 4 naira respectively. Super PLC cost of capital was 10% as at 1st of July 20x3, and it is the policy of the group to measure non-controlling interest using the full value method. For this purpose, the share price of Star PLC is to be used. Prepare consolidated statement of financial position. As you can see the questions, the question is basically on share exchange. And we are told that on 1st of January 20x3, Super PLC acquired the 60% of the equity share of Star when other equity components and the retained earning of Star were 1.2 and 1.5 respectively. Aside from that, we also informed that the acquisition was through a share exchange for 3 shares in Super for every 4 shares held in Star PLC. And Star PLC promised to pay 1,464 on July 1, 20x4. On July 1, 20x4. That is promised to pay later. Also, we also told that the market price of the Super and that of the Star PLC stood at 6 naira and 4 naira respectively. But the Super cost of capital was just 10% as at 1st of July 20x3. 1st of July 20x3. And it is the policy of the group to measure the non-controlling interest, NCI, using the full goodwill method. We know what that means. And for this purpose, the share price of Star PLC.
Sir, which page are you reading from, please?
I shared the slide. You can check your slide. I've already shared the slide on the group. Check the PDF
sir.
that was shared on the group. Please, have you seen it?
Yes, I've seen it, but the exact page.
The exact page is 113. We continue from where we stopped. Page 113. In our last class, we stopped at 112.
I'm there, sir. Thank you.
You are welcome. It's my pleasure. So let me go through the relevant notes once again because of people that are just saying the question. On 1st of July 20X3, Super PLC acquires 60% of the equity share of Star, when other equity components and the retained earning of Star were worth 1.2 and 1.5 respectively. And the acquisition was through a share exchange of 3 shares in Super for every 4 shares in Star. I said, whenever you have 3 for 4, just say 3 over 4, then multiply by the shares. I hope you get that. Then the acquisition was through a share exchange, yes, and promised to pay 1,464,000 in a near future, which is on 1st of July 20X3. And the market price per share of Super PLC and Star stood at 6 Naira and $4 respectively. Super PLC cost of capital was just 10%. And it is the policy of the group to measure NCI at full goodwill method. For this purpose, the share price of Star is to be used. Share price of Star is to be used. Then prepare the consolidated statement of financial position. If not because of time, I would have taken us back to what we solved during the various form of shares, during the various form of subsidiary acquisition, or what we call acquisition of subsidiaries, where I actually demonstrated the various ways by which subsidiary company is being acquired by the parent company. There, we discussed a cash acquisition when you acquire another subsidiary and you pay immediate cash. Then we discussed about share acquisition, which is this form that is being given. Are we together? And also we were, in that question, I gave us an illustration on when you were given the share price, that you just have to convert it to the numbers of shares before multiplying it to the proportion of the shares we were given. Please, if you miss any class, I beg your pardon. Just go through everything once again so that you could have a better understanding of all what we are doing. Group accounting is one of the basic courses, is one of the basic topics, and I can't value it much. If you don't see it in your first question, then your second question, but obviously it comes as the first question. 40 marks, and they can as well repeat it in one of the 20 marks. So you can actually score yourself 60 marks. And do not forget our rules. I call it 7 laws of consolidations. If you've missed the previous topic, please go back and check. For those that we've actually been together, you would agree that we are actually taking it steadily. Okay, because of time. The 7 laws of consolidation, once again, is number 1, you draw your group structure. We said the group structure is the diagrammatic representation, a diagram that shows the numbers of shares that parents acquire in subsidiary. Don't let me give you a headache with key terms. 2 is adjusted retained earnings. Adjust the retained earnings of the subsidiary by having what is the retained earnings in the SOFP. That is the retained earning given in the question. If there's any pre-retained earning, add it so that everything can give you post-retained earnings. That we call post-acquisition. After that, subsidiaries net assets. Subsidiaries net assets, we have DOA, DOC. Is that taken? And having gotten that, the next one is working note 4, goodwill calculation. After your goodwill, you are fine. Go to your working note 5, NCI calculation. After our note 5, your note 6 is consolidated retained earnings, which is the retained earning of the parent. That shows the one you are given in the question, as well as any share of post-acquisition. And your 7 is your what? Investment in associates, where you're given investment in associates. All these things has already been demonstrated in the past. Then you can have working note 8, you can have note 9, you can have note 10 up to note 20. Every other adjustment, put it under your notes. Do we get that? So the relevant adjustments here. Let's quickly look at the relevant adjustment. That's why I have to bring out my pad, my notepad. What are the relevant adjustments? The first one is the share consideration that you're given. Don't worry, I already have everything. I've given it to you. You have the solution already. Okay, it is coined from my lecture notes. All right. Remembered, we have a share consideration. Let me take us back to the question for better understanding. On 1st of July 20X3, it's acquired 60%. Take note of that. It's only 60% that Super is acquiring from Star in order to become a superstar. Only 60%. Take note of that 60%. Is that taken? Because 60% of this share is what we are acquiring. And remember, look at these shares. This share is given a value. What is the numbers of shares? Were we given in the question? The answer is no. If you're not given the numbers of shares acquired, my dear professional colleagues, please calculate for your numbers of shares. Because what first concerns you is the numbers of shares acquired, then multiply it by the value. And I told us that in order to calculate the numbers of shares acquired, just have the shares acquired divided by the what? Subsidiaries' total numbers of shares. Everything we have already examined it earlier. All right, here you are given equity shares of 0.5 each. It is not equity shares of 1 naira each. If it is equity share of 1 naira, you just have 1,000 divided by 1 naira, and the numbers of shares will be what? 1,000. Unlike the previous question that we have been doing. The shares has always been 1 naira, 1 naira, 1 naira. But in the illustration of share exchange, I gave us a sample questions that demonstrated the numbers of shares that the nominal value is not 1 naira. And the reason for examining this question is for us to bring back the memory and see how I can set questions. My advice is pay attention to the question. See, if I thought that you could not lay your hands on Pathfinder or any other thing, just ensure that you go through the slide and you watch the video that is being provided for you by Icon Online Tutors. If you watch it, I promise you, your success is guaranteed. I'm not promising you that you will see the live question as given, like I always tell my students. But you will see a question and I say, oh, your might has given us this. Icon Online has given us this. Not exact questions, but we see a related, and the method we use is already available for you. Please don't miss the track. Stay on track, irrespective of the challenges. Let's go because of time. These shares, it is Star that is acquired, that is being acquired. It is these shares that we acquire. But are we acquiring 1,000 shares? The answer is no, because it is given in what? 0.5 kobo nominal each. It's 0.5 cent. Because it is 0.5 cent, you first of all calculate the numbers of shares, which is what? 1,000,000 It is 1 million divided by what? 0.5. And this will give you the numbers of shares acquired. Is that taken? If you get the total numbers of shares, if you are coming to class, I've always asked you to come with your calculator. Point your calculator. What is 1 million divided by 0.5? What do you have? 1 million divided by 0.5, this should be double. So it should be 2 million shares.
2 million shares.
Thank you. I've always warned you, if you are coming to class, come with your calculator. Next time, if I don't see you with your calculator, I will send you out of my class. So if this is 2 million shares, out of these 2 million shares, we now acquire what? 60%. Are you getting the trend? So what is 60% of these 2 million? That is the numbers of shares you acquired. Are we getting it? So what is 16% of 2 million? Then
1.2.
1.2. Thank you. 1,200,000. But it is this 1,200,000 is what we acquired. But remember, we are not told, oh, we are 1.2 when the other component are retained earning. Don't mind this 1.2. It's just accidental. They said, there's one thing I want to call your attention to, because if you have a question, I want you to break it down just as I'm giving it to you. 60% give us 1.2. This is what we acquire. But how do we acquire it? The acquisition was through a share exchange of what? 3 shares in Super for every 4. When you see 3 for 4, my dear professional, just say 3 for 4. When you see 2 for 5, just 2 over 5. 1 for 3 is 1 over 3. Your 4 is divided. At times, they might use 7 for 10 or 10 for 7 or 5 for 2. If it is 5 for 2, don't say the small one must always come at numerator. And don't say the denominator should be the highest. It doesn't work like that, irrespective of what they've given to you. If you hear 4, the first one comes at numerator, the second one comes down, denominator. Now, share exchange is 3 for 4. This is 3 over 4 of 1.2 is 2 share exchange. The remaining one is through cash. Do we get that? The remaining one is through cash. That's why they said a promise to pay 1464 on July 1, 20x3. But how much does it pay for through the share exchange? Remember, and they said the market price per share of Star and Super were 6 naira and 4 naira respectively. And they said it is 3 shares in Super for every 4, which means after calculating this, whatever you have, what is the numbers of shares? 3 over 4 divided by 1.2. What do you have? 4 year 1, 4 year 3. This should give you 900,000. This is the 900,000 shares. This 900,000 shares, now multiply it. What is the market price share of Super? The market price of Super and Star. Super comes first before Star. Super is 6, Star is 4. That means this 9,000, you now multiply it by what? So the value of the share now will now be Super is $6 multiplied by the numbers of shares acquired, 900,000 shares. Do we get that? Which means the values of the share. Thank you. The values of the share is 5,400,000. And the value of the cash is what? 1,464,000. Do we get that? So the total value will now be what we are paying for it. I hope that illustration is clear. And this 5.4 is to be added to the cost of investment in subsidiaries. I hope we get that simple and logical illustration. But if you want to calculate the nominal value, this is the market value, don't forget. If you want to calculate the nominal values of the share, if you are bringing the shares here, the nominal value will now be this 900,000 shares that we acquire. Nominal value will be this 900,000, just have 900,000 shares multiplied by, what is the nominal value? You can see it here. The nominal value is 0.5. Just have 0.5. I hope that is cleared. So if you want to determine your share premium, whether there's a profit on your shares, whether there's a share premium or not. Yes, see now, we have share premium here. If you want to determine the share premium that you acquired, it will just be the market value, which is this 5.4 minus this nominal value. Let's demonstrate. What I'm just giving to, what I gave to you is to have an understanding of how it's being solved. Now, let me give you the full clue. I don't want to rush you because understanding is the basis. As soon as you understand, you have the solution. I'll just be telling you, that is how I got this, that is how I got that. We have the share consideration. You've already know this. So we have numbers of shares acquired. Numbers of shares acquired. And the numbers of shares acquired by parent company multiplied by your what? Conversion ratio, or what you call conversion rate. Just the numbers of shares acquired multiplied by what? Ratio acquired. Nobody will penalize you for that. What is the numbers of shares that you acquire? You acquire, as we demonstrated, 1 million shares divided by the 0.5. Okay. Oh, numbers of shares acquired is 60%. 60% of 1.1 million divided by 0.5. Then the ratio you acquired is what? 344. And that was how we get our what? 900 million shares. The one we did earlier. You know, while I was explaining it for you, then I broke it down level by level. So now you should understand how I got this. 60% multiplied by the 1 million divided by 0.5 in order to get the numbers of shares. If I still want to break it down, you say is 60% acquire of 2 million shares, the one we did earlier, then multiply by the rate of the share, which is 3/4. And that's to give me my 900,000. Then what is the market value? The market value, as I've been given, the market value of the share acquired or of the shares consideration. The market value of the share consideration is $6 for every 900,000 shares considered. So, and this gave us, what does it give us? So, okay, somebody said 5,400. Since this is the market value, then what is the nominal value? We need the nominal value in order to get the share premium. That's the essence. Otherwise, we would have just stick to this. And what is your nominal value? Our nominal value, as we know, is the what? Is the numbers of shares, is the share price. Nominal value is share price multiplied by the shares consideration. And what is our nominal values of per share here? It is 0.5 multiplied by the shares consideration or the shares acquired, 900,000. If you multiply, point your calculator, what do we have? Okay, this should be half of this. Half of this is 450,000. Since it gives us 450,000, then the next one is you've gotten the share acquisition, you've gotten everything. Then let us calculate the share premium. So our share premium now, will now give us, our share premium will now give us, what do we get for the first one, which is 5,400,000, 5.4 minus our what, 450. This one is in million. Okay, we can say 5.4 minus 450. Whatever we have, we should have 4,950. So 4,950 is just our share premium, and that is to be added to share premium in the statement of financial position. Do we get that? Let's go to the next one. Don't worry, you have the solution. No, you have nothing to fear. Let's go to the next one. We have just dealt with this. Then the acquisition was through share exchange. We are through with that for every share. Promise to pay. When they say promise to pay in a future date, that is an obligation. It's promised to pay 1,464 on July 1, 20x7. This one is July 1, 20x7. It's caught here. I don't know. Sorry. It's July 1, 20x7. July 1, 20x7. From when? When was the company acquired? The company was acquired on July 1, 20x3. Just ask yourself, July 1, this is 1/7/2003. Let's say 2003. To what? When is it going to pay the 1,464? It's going to pay it on July 1, 2007. How many years in between? 2003, 2004, 2005, 2003, 2004, 2005, 2006, 2007. How many years is that? That is what? 4 years after. Is 4 years after. Because 2003 that acquire is gone. So 2004, 5, 6, 7. That is 4 years. And remember, when we do our deferred consideration, that one also is from our first slide. The slide that I shared to you on the group, please check it. Start from the basic consolidation. We've treated and we have also looked at deferred consideration. And deferred consideration is what will be the price? What will be the present value of this price as at now? That is the reason for calculating deferred consideration. And for the deferred consideration, let me just call that one. Okay, did I number this one? Okay, I call that one 1. Let me call this one 2. That's deferred consideration. It is deferred consideration because it postponed the payment. It postponed the payment. And when someone postponed the payment, we all know that is a future value. The future value is 1,464, which is the amount is going to pay as at 1st of July 2007. But what is
the excuse me, sir. Sorry. Excuse me, sir.
Yes, sir.
You said 1,464. That's 100 here from the question.
Okay, 1,464, 100.
Good.
Oh, thank you. God bless you, sir. So 1,464, 100 is the future value. It's what it promised to pay in the future. That one, you call it future value. But what is the present value of that money now? That is what we want to calculate. Because the consideration is deferred. We cannot measure it perfectly. But suppose it's paying now. What would have been the price to pay? That is the reason for the deferred consideration. So for the deferred consideration, we always use the value of the present value, the formula for present value we were given in our, while we are doing the basic consolidation. The present value, we remember our annuity. Present value is just a future value in bracket 1 plus r raised to power what? Minus n. Yes. Present value is future value, FV in bracket 1 plus r raised to power minus n. I can't give us, but this one is what you can actually get. Do we get? Just say where, what is your future value? Future value is the price you are paying in 4 years, in 2007, which is 1,464,100 as corrected. Is that taken? What is your rate? We were given the cost of capital of the parent company. Super PLC cost of capital was what? 10%. Cost of capital is the rate. Do we get that? Because cost of capital is the rate of return investors is expecting on their what? Investment. Do we get that? We are not in SFM class. So our R is what? 10%. We have already been given. 10% is the same thing as your 0.10. Please take note. Then what is your N? FV is this, R is this. 1 is constant. 1 is constant. Then what is our N? Our N is from 17-2003 to 17-2007. That is how many years? 2003 is the current year. Leave that. You start from 2004, 2005, 2006, 2007. And remember that it is from 1 July. This one is also from 1 July, which means it is this date that is also ending. But let's assume that it is December 2007. That will be 4 years, 6 months. But because this one is also on first, so we say this is what? 4 years. Our numbers of years is 4 years. Then when you have everything, what do you remain? Just insert it. You can rewrite your formula if you like, because me, I like writing the formula because those people can just say they don't know how I arrive at this. So since you have already rewritten your formula, what is your FV? Just start putting those figures. 1,464,100 in bracket 1 plus 0.10 raised to power minus what is your N4? I hope you are with your calculator. So please punch it. First of all, how do you press your calculator? You will have your 1,464,100 in bracket. You will press 1 plus 0.10. That one is 1.10. Okay, let me still narrow it. So we have 1,464,100 in bracket. In your calculator, press 1.10. Then you will see, after pressing that, don't open bracket. You will see a yellow this thing there. Like yellow, it is, I mean, it's red in some calculator, which is the second, we have shift. That one is other this thing. Just press raise to power. It looks like this. Locate this. Locate this in your calculator. If you press it, you will see small minus. They always put that small minus in bracket. Press that minus, then press 4. At times, if you press your big minus, it can also give you. So press 4, then press is equal to. It will give you a figure. Whatever it gives you, write it here. Multiply it by 1,464. When you multiply it, you should be having 1 million, if I'm not mistaken. So it means it is 1 million that he has deferred. And that 1 million that he deferred should also be added to your cost of what? Investment. Is that taken? Under our cost of investment, we'll be having deferred consideration plus the share exchange. Remember that the share exchange is what? 5.4. So we'll be having total cost of investment, or let's say total cost of, let's say cost of investment. So our cost of investment now, therefore, cost of investment will now be share exchange. This is how to do it too. That's why I'm taking my time to demonstrate it. Share exchange. That is, let's assume that it's already in thousand. Share exchange will be 5,400. Then you will have deferred cash, PV. It is PV that you did. In order to get the value now, PV of deferred consideration, then that one is what? 1,000. So if you add 1,000 to 5,4, 1 plus 1, 6, that is 6,400. That 6,400 is your cost of what? Investment. Is that taken? After this, you now say add NCI value at DOA. Do we get that? But it is also impetuous. It is important for us to know that at times we have to calculate our unwinding costs.
Excuse me, before you go for that, please.
All right, sir.
It's a cost of investment, share exchange, which is 5.4.
Yes, sir.
But we now had our deferred consideration, 1 million.
Yes,
Why
sir.
do we have it? It's not that clear. Please explain.
Thank you very much. The reason for adding the 1 million is the total cost. How much do we pay in total for the acquisition? Remember that the acquisition was done in two different ways. The first way is through share exchange, which is this share. The second one is through deferred consideration by postponing that amount. That is the two ways of doing it. One is through share exchange. The other one is through deferred consideration by promising to pay in the future date. But this money that we want to pay in the future date, this money we want to pay in 4 years' time, what is the what now? The what as
The
at
present
now
value
is,
now.
yes. So the present value now, which is the what now, is 1 million. We have to add that 1 million to our share exchange in order to know how much are we actually paying now for that share acquisition.
Assuming you are paying the money now.
Yes, assuming we are paying the money now.
Paying the money
Because
now.
for that share, it's getting the value of the shares, but it is the money that is not getting now. But let's assume that we are paying the money now. How much?
We have to pay 6.4.
Exactly. That is what it means.
Okay.
I hope it is clear for everyone.
Yeah, it's clear. Thank you, sir.
You are welcome, sir. So, if I now ask you, let me now ask the class. The reason why I'm taking this class gently is because you need to understand this. You need to understand it. Having understand this, every other question, you will solve it on your own, honestly. What is the interest element on that deferred consideration? Anybody? Remember we said, having calculate the interest. Having calculate the present value, we will now calculate our unwinding cost. And that unwinding cost is what we call interest element. What is the interest that is being paid? It is as easy as this. How much is the present value? Suppose we are paying the money now, we would have paid 1 million. Is that not? But because we are not paying the money now, let me call it unwinding cost. Unwinding cost is just a grammar. It means the interest. Okay, so don't think too far, please. So, suppose you are paying the money now. See it though. PV. PV means if you pay it now, or should I call it the what now or value now? Okay, let's say we are paying it now. Sorry for using a layman language, it's for us to understand. Suppose we pay now, we'll be paying this thing gets this thing. We'll be paying 1 million. But because we are paying it in the future, which is in 4 years' time, because we are paying it in the future in 4 years' time, how much are you paying? We are paying 1,464,100. Now, how much has been added because we are not paying the money now? That is your interest. It's like you borrow money in the bank now. So if you don't pay, as the years or the days is increasing, your interest is accumulating. That's just it. The differences between 1,464, 100 and 1 million is what is called your interest element, which is 464, 100. And that is what you call your unwinding cost. I hope that is cleared. I hope that is cleared. So truly, if you want to show the unwinding cost on it, it is 464, 100. Now, let's enter into it proper. What I just do are what is called the relevant notes. Okay, we still examine it. I will still refer you back. We still have some other relevant notes. So let's consolidate, my people. Remember, that is the policy of the group to value non-controlling interest using full goodwill method. When you are using full goodwill method, what are you doing? If you are using partial goodwill, what are you doing? It's the same thing, fair value and proportionate. Okay.
Sir,
no.
all this we've done is not even part of the 7 rules. So 6.
Yeah. Yes. What we've done is other notes. Yes, sir. It's other notes. That is why I said. That's why I said your notes can be more than the 7 rules. So you can have 8, 9, 10, up to 20. Is that taken? It depends. But just ensure that you observe that of 4, 7 rules. Then the other ones will now come under other adjustment. And if you don't want to call it other adjustment, you can have working note 8, you solve, working note 9, you put it, working note 10, you put it. Just like all this one that I've done. I can call this share consideration working note 8. Nominal value, I can call it working note 9. I can call this one 8. I can call this one 9. Deferred consideration, I can call it 10. Even this total unwinding cost, I can call it 11. Then if there's a need for me to prorate the unwinding cost, I will call it 12. Then I will prorate based on the question. Do we get that? Yeah, so let's look at the solution. I hope you've gotten the idea of what we want to do. Since you now have the idea, so it is much easier for us. But do not forget, if you have missed the basic consolidation, please go back. When you go back and you are checking it or you are watching the video, drop your question on the platform. I shall be available to attend to them. Let's go to our relevant notes. Don't look at what you are seeing at the top. This is the working notes. The working note 1 is what? Group structure. Group structure, super, acquire, star, 60%. So NCI will be what? NCI at 40%. It's not taking. Oh, sorry. I was trying to manage my space. So your working note 2 is adjusted retained earnings. You see subsidiaries retained earning in the SOFP. Just come to your SOFP. This is your SOFP. Subsidiaries adjusted retained earning. Adjusted retained earning. This is the retained earning. This is parent. This is subsidiary. Subsidiary is what? 9.5. You now look at the additional information. Is there anything relating to the retained earnings of the subsidiary? They said, as at 1st of July 2003, super acquired 60% when other equity component and retained earnings stood at what? 1.2 and 1.5 respectively. They didn't tell us that it was having a retained earnings as at what? That the retained earning it was having was in debit or was in credit. They just tell us that it stood at what? Now it stood at 1.5. I hope you are getting it. So because it stood at 1.5, you can just adjust your retained earning by having retained earning in the SOFP 1.5, then pre-acquisition. Pre-acquisition is 1,500,000. If you remove 1,500,000 from 9.5, you'll be having what? 5. You'll be having 8,000. So this is your post. This is the adjustment you want to do. Subsidiaries retained earning in the SOFP 9.5, then pre-acquisition of 1.5. You are having post-acquisition of what? 8,000. So this 8,000 is your post-acquisition, and this is what will be shared. Is that taken? But we were also told that other equity components, look at the question. We now go, we have other equity components. We're supposed to adjust for this, but we will do that in the statement of, in our adjusted subsidiary net assets. Okay, what we do under working note 2 is adjusted retained earnings of the subsidiaries. And the working note 3 is subsidiaries net assets. For subsidiaries net assets, as I always say, the net asset is all this equity that is being acquired, all this equity that we are given. That is what we call subsidiaries net assets. Is that taken? That is the subsidiaries net asset. Subsidiaries net asset is equity share, share premium, other components, and retained earnings. So since you've already gotten that, you just write them down. Equity share, share premium, other equity, and retained earnings. I always say that the balance given in the statement of financial position is your DOC, while your DOA is if you're given any other information. And if you are not, then it means what you are given here is also the same thing as what you have in your DOA. Like equity shares here is 1,500, 5,000, and 9,500 respectively. You will just bring them down here: 1,500, 5,000, and 9,500. Then, did they give us any information relating to ordinary shares here? Equity share of Star? No. It means our share acquisition still remain the same, 1,000. Share premium 500. But we were told that the retained earnings stood at what? Other equity component. This other equity component and retained earnings, and this retains earning, both stood at 1,201.5. It means other equity component is having 1,200, and then retained earning is having 1,500. So you will adjust for that. You will put 1,200 and you will put 1,500. Is that taken? So your post-acquisition is your DOC minus your DOA. So that is how we are having.
Yeah, excuse me, sir, please.
Yes, sir.
The other equity component of 1.2. Is it from the question?
Yes, sir.
Please, I can't find it too, please.
On 1st of July 2003, Super PLC acquired 60% of equity share of Star when other equity components and retained earnings of Star were worth 1.2 for other equity, 1.5 for retained earnings.
Okay. Thanks,
is it clear?
Yes, clear, sir.
And our post-acquisition is DOC minus DOA. DOC minus DOA. Is that taken? DOC minus DOA. So because it is DOC minus DOA, we have 1.2 minus 5,000. What will it give you? Then if you have 1.5 minus 9.5, what will it give us? Just say DOC. This is DOC. This is DOC. 9.5 minus 1.5, it gives us 8,000. We've already done that here. Then 5,000 minus 1.2, will give us 3,800. In all my other calculation, I always bring DOC first, but I just brought this so that you can see that irrespective of how you put it, it is still the same thing. Just understand that your DOC is minus your DOA. Is that taking 1,000 minus 1,000, 0, 500 minus 500, 0, 5,000 minus 1, 2, 3, 8, 95 minus 1, 5, 8,000. Then balance everything. If you balance 38 plus 8,000, we give you 11,800. 1,000 plus 500 plus 5,000 plus 95 will give us 16,000. Then 1,000 plus 500 plus 1, 2 plus 1, 5, it gives us 4,200. The essence of calculating this is to get our subsidiaries net asset at DOA, which is this, and to also get our post-acquisition, which is this. Because all those are part of what we are going to use in our next calculation or working note, which is what? Goodwill acquisition. Your working note 4, your rule 4, your basic rule 4, which you must not forget, is goodwill calculation. When we say goodwill calculation, we have demonstrated this before. Market value of the share consideration, that one is 5,400. This one is in workings. We have done this. PV of deferred payment, 1,000. We have done it, Abi. So the total cost of investment is 6,400. Having gotten 6,400, then we will now add NCI value at DOA. So let's go and calculate for the NCI value at DOA. Though the NCI value at DOA should have been this 4,200, but the reason why it is not the 4,200 is because there's a need for the what? Adjustment. So shall we quickly look at that? Let me open down my jotter. So now let's do our subsidiaries net asset at DOA. Are we together? So let me call it subsidiaries net assets. Subsidiaries net assets. I promise you, after this question, just go and pick any other question and you are fine with them. Okay? So for the subsidiaries net assets, we'll be having, the first one is, what is the, we acquire 60% of the equity shares. Shares acquired, let me bring back our memory. Share acquired is 60%. Remember, and our NCI is 40%. Remembered. Okay. So the market value of the shares that is being acquired, what is it? You remember how we calculate this parent company's share acquired, 60% of this. The same thing. Let's do it for the subsidiary. The remaining part that is not acquired. The subsidiary's shares is what? Let's forget that 40% first that was acquired. What is the market value of the subsidiary share? Just say market value of subsidiary share. The market value of subsidiary shares is what? Is 1 million. This is it. Subsidiary share is 1 million at what? 0.5. Do we get that? So it's 1 million. 1 million divided by is 0.5. Then what is the market value of the subsidiary? Look for it. In the question, we are told that on July 1, we are told that the market value, the market price per share of Super is 6 naira. That's for acquisition. And that of the Star is what? 4 naira. That is subsidiary. No, go back to your listing. The market value of Star is what? $4. This will give us the market value of the shares. Do we get that? Now multiply it by what? Now multiply it by the 40% of the NCI. This will give us 1 million divided by 0.5 is 2 million. 2 million multiplied by 4, this is 8 million. So it means it is 8 million. 2 million share at 4 naira is 8 million. Then this 8 million multiplied by what? 40%. If you multiply it by 40 over 100, you'll be having
3,200,000.
God bless you. This 3,200,000 is what was acquired. Do we get that? This is the share value. This is the NC. Therefore, our NCI value at DOA is what? 3,200,000. Is that taken? Though the one on the net asset is giving us 4.2. That is the one that we have. This one is giving us 4.2 shares of at DOA. But this share has already been prorated and it has already been assigned the market value. Do we get that? So we have to measure it in what? Market value. That is how I've gotten this my 3.2. You have everything here too. Fear no fool. Okay. So your cost of investment, add the NCI value at DOA. You have 3.2. So 6,400 plus 3.2 will give you purchase consideration of what? 9,600. Then let's your subsidiary net asset at DOA. This is your subsidiary's net asset at DOA, 4.2. 96 minus 4.2, you will have your what? 5,400. Is that taken? Since you've gotten your 5,400, the next one is what? NCI calculation, which is your working note 5. So my working note 5 is NCI.
Sir, it's like something strange happened here.
Yes, sir. Hello, sir. Is it the calculation of NCI? Okay. For the calculation of NCI, we have our NCI value at DOA. NCI value at DOA is 3,200. This one that you calculate, this one. NCI value at DOA is 3,200. Then what is the post-acquisition? Your post-acquisition is 11,800. 40% of 11,800 will give us 4,720. Sorry, it cut. So I've sent the PDF files. 3,200 over 4,720 plus 4,720 will give us 7,920. And that is our NCI calculation. Our working note 6 is calculation of consolidated retained earnings, or what you call consolidated retained earnings, and it is the retained earnings of the parent companies alone. You will have the parent retained earning in the SOFP. Just check. Retained earnings in the SOFP. This is retained earning in the SOFP. you have 25,000. Then you also have other equity components, 8,000. But our retained earning is what concerns us. Retained earning is what? 25,000. Add parent post-acquisition, which is 60% of parent post-acquisition. But before that, you have to add your what? You have to less your unwinding cost. Remember, I called unwinding cost for us as our what? Interest element. Okay. How do we get this, our unwinding cost? Go back. Look at your statement. If it is not stated in the statement, then you will have to go to your working note and calculate for your what? Your unwinding cost. Is that taken? Unwinding cost is the interest element, as you were told earlier. That is our unwinding cost. And you have to remove it from the retained earnings. I hope we are getting that. So let's quickly disappear to solve for the unwinding cost. You're okay. You already have everything here. Yes, this is our unwind. This is the relevant notes that I told you earlier. This is the 9,000 shares that was acquired. This is the market value. This is the nominal value. And this is the premium. You can see as I calculated it. And the second one is deferred consideration, which is the 4 years and our 1 million that we get. So for the unwinding cost, the PV of the deferred consideration, PV of the deferred consideration is what? 1,000 naira. Then unwinding cost will go as 6 months interest. Remember that the first one, let me solve it for us so that we can get it better. It's because of time before, but let me do it. Unwinding costs or interest element. Interest is paid yearly. Hope you didn't forget that. So you start from the first one. You start from the first one, which is the PV. The PV is that this thing that we calculated. So PV of consideration. The PV of the consideration is what? 1 million. That is the PV that we calculated. Then remember that it was acquired in July. Where is the first one where we solve our month? Yes, this is the total interest. The total interest is this. But yes, the company was acquired on July 1, 2003. So from 1st of July to December 2003, you just say 2003 interest. Please get it. 2003 interest. We give you what? What is the cost of capital? The cost of capital is 10%, which is the interest element. Remember, I said cost of capital is the rate of return on investment. We remembered. 10% of what? What is the 10% on this 1 million? But are we earning it for the July? For 2003, it's just from July to December. July to December. If you count your finger, you will have July, August, September, October, November, December, which is 6 months. So in 2003, we only have 6 months out of the whole what? Year. And this will give us what? Punch your calculator, 10% of 1 million on 6/12, it will give us 50,000. Okay, to that regard, let me put my 1,000 here. This will give us 50. So 1,000 plus 50, I will have 1,050 naira. So it means as at the end of 31st of July, my deferred liability is 10,050 naira. Do we get that? So deferred liability for 2003. Deferred liability is 1,050 naira. So this 1,050 naira in 2004 is what we charge interest on. Remember that your interest accrued evenly. So your interest will be 10% on this 1,050 naira. And if you calculate 10% of 1,050 naira, this will give you 105. So in 2004, you are recognizing 105. In 2003, you are recognizing 50. Do we get that? So if you add this together, you will have 1155. This is your deferred liability as at 31st of December 2004. Before you continue, which year is the year of our accounts we are preparing? Let's check our question for that. Okay, our account is on 30th of June 2005, which means we prepare our deferred consideration to June 2005. So our interest for 2005, our 2005 interest will also be 10% on 1155. And that will give us what? 116. It is this 116 we are recognizing. So if you add everything together, we have 1271. You see that you take this interest element directly to reduce it from your subsidiaries account, or you add it year by year. It is either the same, because this interest must be deducted from the retained earnings of the parent, because it is a deferred liability. Deferred liability. Liability means amount you are owing that you postponed. I hope that is taken. Let's go back to our working notes. So for the retained earnings, we have unwinding costs, which is what? Unwinding costs as calculated is what? 271. So that 271 is what you got, is what we've gotten under our unwinding cost, which is called interest element. And for the 2003, we have 50, 2004, we have 105, 2005, we have 116. Then post-acquisition profits of the parent company. What is the share of post-acquisition? Just 60% on what? Is only sharing this 8,000. So 60% of 8,000 will give us 4,800. So 4,800 minus this one is interest, is paying it. It's not earning, it's paying that interest. So 25,000 minus 271 plus 4,800, you will have 29,529. Okay, 29,529. Since we've done that, we also have other equity. So go and do consolidated other equity. For all our 7 rules, we never have other equity there, but other equity is also a component. Do not include it under retained earnings. So you have parent equity as that SOFP. If you look at the SOFP, other equities of the parent, 8,000. So you will have other equities of the parent in the question, which is 8,000. Then you will have share of post-acquisition. Share of post-acquisition of the parent is 60% of 3,800, and that one give us 2,280. If you add the two together, you'll be having 10,280. You've done your 7 rules of consolidation. There's no need for investment in associate because no associate involved. So the rest that I did for you is what we have already done in that our adjustment notes. We've done everything. The next thing is for us to just consolidate. To consolidate, just do your line by line items. Remember what I told us. PPE, 25,200 plus 800. Available for sales, this plus this. Other tangible software, available for sales, this one cancelled though. So PPE, inventory, this plus this. Every other one, that for that. Then you will have available for sales, this plus this. Other intangible software, this plus this. Then your goodwill, you will include your goodwill. Your goodwill must be included there. If you look at this question, you will see that we did not have investment in Star. Investment in Star is not there. As a result, it's not necessary because you have it in your other information. So don't bother yourself much. Just do your what? Just do your other line items. So that's why I have my non-current asset, PPE, goodwill, which is working note 4, available for sales, 48 plus 2,000, other intangible assets, 3,000, and we have the rest. Current assets, inventory, liabilities. Our account stood at 104,400. The 104,400. Also, equity and liabilities. I'm having equity shares, non-current assets, then my non-current liability. This is it. Everything balanced at 104,400,000. That is all about Superstar questions. If you have any question, do not hesitate to ask. Are we together? All right. If you are clear with that, we shall move to the next question. Are we clear with that? Shall we move to the next question? If the answer is yes, please, you can unmute yourself. Okay. Because of time, let's quickly move to another question. You also have question to practice. I'll leave that for you to practice. We have on 1st of January 2014, Segun acquired 80% of the equity share capitals of Bolu, and the consideration was satisfied by a share exchange of 2 shares in Segun for every 3 shares acquired by Bolu. Can you see that? 2 shares in Segun for every 3 shares acquired in Bolu. And at the date of acquisition, shares in Segun and Bolu had a market value of 3 naira and 2.50 respectively. So close to the question we just finished. Plastic will also pay a cash consideration of 25 kobo on 1st of January for each shares acquired in Bolu. But Segun had a cost of capital of 10% per annum. And none of this consideration has been recorded by what? Segun. And we are given below are the summarized statement of comprehensive income of the 2 companies. Revenue up to total comprehensive income and we have our SOFP given as well. All right, let's go to the additional information that's concerning us most. For the additional information, we have at the date of acquisition, the fair value of Bolu's net assets and liabilities were equal to their carrying amount, with the exception to what? Bolu's PPE, which had a fair value of 4 million naira above his carrying amount. For consideration purposes, this led to an increase in depreciation charges in cost of sales of 100,000 naira in the post-acquisition period to 30 September 2014. But Bolu had not incorporated the fair value property increase into his entity's financial statement. It is the policy of Segun Group to value all properties to fair value at the year end. And as at 30th of September 2014, the increase in Segun property has already been recorded. However, a further increase of 600,000 naira is in the value of Bolu's property since its value at acquisition, and 30th of September 2014, this value has not been recorded. On 30th of September 2014, Segun accepted 1 million 10% loan note from Bolu. 2. Sales from Segun to Bolu throughout the year ended 30th of September 2014 had consistently been 300,000 per month. Segun made a markup on cost of 25% on all these sales. 600,000 naira at cost to Bolu of Bolu's inventory as at 30th of September 2014 had been supplied by Segun in the post-acquisition period. Segun had a trade receivable balance owing from Bolu of 1.2 as at 30th of September 2014. This deferred to the equipment trade payable of Bolu due to a payment by Bolu of 400 made in September, which did not clear Segun's bank account until 4th of October 2014. Then Segun policy for cash timing difference is to address the parent statement of financial position. 5. Segun policy is to value the NCI at fair value at date of acquisition. For these purposes, Bolu share price at that date can be deemed to be representation of fair values of Bolu. Due to the recent adverse publicity concerning one of Bolu's major product line, the goodwill which arose on acquisition of Bolu has now been impaired by 500,000 naira. Take note. As at 30th of September 2014. Goodwill impairment should be treated as an administrative expense. Take note. Let's assume, except where indicated otherwise, that all items of income and expenditure are accrued evenly throughout the year. Prepare the consolidated statement of profit and loss and other comprehensive income of Segun. Then prepare consolidated statement of financial position for Segun as at that date. C. Segun is the process of recording the acquisition of another subsidiaries, Dare, and has identified 2 items when reviewing the fair value of Dare's asset. The first item relates to 1 million spent on a new research project. This amount has been correctly charged for P&L by Dare, but the director of Segun have reliably assessed the fair value of this research to be 1.2. The second item relates to customers of Dare, and the directors of Segun believes Dare has a particular strong list of reputation customers to be sold to other companies, and have assessed the fair values of the customer list as at 3 million naira. Required to state whether the fair value of the 2 items should be recognized on the consolidated statement of financial position of Segun as at acquisition date. So let's go through the question. This is just an advanced question of it. Okay, let's go through the question and let's solve. The first one we did is just statement of comprehensive, that one is just statement of financial position. Now we are examining both the statement of comprehensive income and statement of financial position. Okay, in a few minutes, let's quickly do that. So, since we have perused the question, let's solve. If you look at the question very well, you will agree with me that it also involves the share exchange, then it have a carrying value. So let's go by our rules again. The first one is prepare your group structure. And for the question, if you look at the question, you will see that it was acquired. Look at the question. At the date of acquisition, the share value of Bolu's net assets equals to their carrying amount, with exception to Bolu's property. For consolidation purposes, this leads to an increase in depreciation of 100,000 naira in the post-acquisition period to September 2014. When was Bolu acquired? On 1st of January 2014, Segun acquired 80% of Bolu. But when was the year ended? The year ended was what? September. January to September, you will count. It is not up to a what? A year. You have to take note of that. The year end is 30th of September 2014, and Bolu was acquired on January 2014. January to September, this is Segun's group. The next one we are doing now is Segun group. Year end. The year end is 30th September. An acquisition. He acquired another subsidiary on January 1st. Year end 2014. January 1st, 2014. From January to September, how many months do we have? We have just 9 months. If you remember in our last class where we did our mid-year acquisition, you will agree with me. I told us that we have to divide it by the numbers of year, which is the one we looked at last time was acquired in July. So we divided it by 12. This one is acquired on January to September. How many months? That is 9 months. So you have to have multiplied by 9/12. Is that taking? So draw your group structure. The first one is your group structure. Your group structure should be what? Segun acquired Bolu. Now put the date. 1/1/2014. Just say 9 months. Okay. It's acquired 80%. So NCI at 20%. You can put it anywhere. Since you've written 9 months to the year end, you will know that anything you are doing is 9 months. Working note 2, adjusted retained earnings. What is retained earning in the SOFP. Look for the retained earnings in the SOFP. Bolu, retained earnings. Retained earnings in the SOFP is equity share plus retained earning is 3,500. Retained earning is 3,500. So you have your 3,500. Check if you're given any other adjustment, but you can still leave that and go to the next one, which is your working note 3, subsidiaries net assets. Subsidiary, okay. Retains earnings, adjusted retained earnings in the SOFP is 3,500. Go to the question. At the date of acquisition, the fair value of Bolu's assets. The fair value of Bolu's asset and liability were equal to their carrying amount, with exception to this and that. Okay, that is fine. For consideration purpose, this led to an increase in depreciation charge in cost of sales of 100,000 naira. Okay, that one is normal. To this, it is the policy to value this. The Segun's property, however, further on 30th of June, on 30th of September, Segun accepted 1 million 10% loan note from Bolu. 10%, 1 million loan note from Bolu. Okay. At cost of acquisition, Bolu's inventory cost 1.5. Segun had trade payable. This defined the Bolu's payable of Segun's policy is to value NCI at fair value at date of acquisition. For this purpose, Bolu's share price at date has been deemed to be the representative of the fair value. Due to the recent adverse, Bolu suffered 500 naira. Okay, that is the goodwill impaired. Is there any pre-acquisition? If you did not have any pre-acquisition, okay, sorry, we can check here. Segun acquired 80% of Bolu. The consideration was satisfied by share exchange of 2 shares for every 3 shares held. That is the consideration. 2 shares for every 3 shares held. 2 shares for every 3 shares held in Bolu. And at the date of acquisition, shares in Segun and share in Bolu had a market value of what? 3 naira and 2.5 respectively. 3 naira for Segun, 2 for Bolu. And Segun will also pay a cash consideration of 27.5 kobo on every January. On 1st of January 2000X5. This is the FAD. For each of the shares in Bolu, this is the FAD. Segun had the cost of capital of 10 naira per annum. Oh, sorry. Yeah, let's go. Leave this. Let's first of all do the relevant adjustments in the questions. Okay. What are the relevant adjustments? The relevant adjustments include the share exchange, just like the first one. What is the share exchange? I hope we now know it, so we can do it better now. The share exchange is 2 for every 3. Two shares in Segun for every 3 in Bolu. That is 2 shares for every 3 shares. Are we together? That is 2 shares for every 3 shares. And also, 2 shares for every 3 shares. Equity shares of 1 naira. This equity share of 1 naira has already been given. If you look at it, we have equity shares. Equity shares of 1 naira in Segun is 10,000. In Bolu is 9,000. Okay. So for Segun, for Bolu is 9,000. Just like the first one. 2 shares for every 3 shares. I want to call your attention back. You see, shares consideration, the one that has been acquired. And this one we acquired 80%. So 2 shares for every 3 shares will be 2 shares for every 9,000 shares in Bolu. This will give us the numbers of shares acquired. Then multiply it by the value. I hope that is cleared. So because of time, 2/3 multiplied by 9,000. What do we have?
6,000.
6,000. Thank you so much. So this 6,000 shares, to now get the numbers of shares acquired, will now be numbers of shares acquired will be 80% of this 6,000. What is 80% of the 6,000 now?
That's 4,800.
That 4,800 now multiplied by the market value. What is the market share price?
Is it
of
the Bolu or Bolu is 2.5?
No, market price of Segun. When we are
That's 3
calculating
naira.
for the share exchange, it will be that of the what? Bolu.
What?
It will be that
Bolu.
of the Segun.
Segun, that's 3 naira.
That is 3 naira. But when we are calculating for NCI, it will be that of the Bolu. I don't think we are getting it. If you are calculating for the parent company, you know the share acquired is for the parent company. If you are calculating for the parent company, you will use the market value of the parent. If you are calculating for subsidiary, you use the market value of the subsidiary. So this one will be 3 naira, which is the share price of Segun multiplied by 4,800.
That's 14,400.
This 14,400. Remember what I'm calculating is cost of
Not
investment.
14,000, it's 14,400.
14,400. Thank you so much. What you are calculating is cost of investment. Let me do it like this. Cost of investment. It is in 2 forms. The first one is share exchange. The share exchange is 2 for 3. Is that not? Multiply by this. Now, what is the cash consideration? What is the deferred consideration? For the deferred consideration, what are you going to do? Quick note, you will find the PV. And the PV equals to the future value in bracket 1 plus R raised to power minus N. That is why they will give you the cost of capital. Are we together?
Yes,
They will give us the cost of capital. When you are having the cost of capital, that should be calling our attention. Okay, this I'm doing is breaking down where FV is the future value. What is the future value? Go back to your question. And also pay cash consideration of 27.5 kobo on 1st of January 2005. He paid a cash consideration. What is the price of the cash consideration that he paid? On 1st of January 2015. 1st of January 2015 is what? How many years? We need to calculate 1st of January 2015. He paid
I think it should be 1 year. Abi.
Sir?
It should not 1 year.
That's what I want to calculate. Wait, you also pay cash consideration of, look at this cash consideration. They just say cash consideration of 27.5 kobo. You will see that they didn't mention the amount. Hello?
We are hearing you, sir. Continue.
They didn't mention the amount. They only say he paid a cash consideration of 27.5 kobo. Go back to your working notes. The future value here is not stated. We are coming. The rate is 10%. But the future value has been given as 27.5 kobo. 0.5 kobo is divided by 100. That is 27.5 divided by what? 100. Multiply by what is the share exchange? What is the share price? You now go and look out for the market value of the share price. Let's check additional information, whether we have where we are given us. At the date of acquisition, shares in Segun and Bolu had the market value of 3 naira and 2.5 respectively. Whereas Segun will also pay a cash consideration of what? 27.5 kobo on it. Investment. Oh, they didn't tell us investment in Bolu. You can't use that. You go and look for the cash consideration that he paid. And we can only get that either under the note or to calculate using the numbers of shares. At the date of acquisition, the fair value of Bolu is also 4 million. We are not given expressly. Likewise, the policy is to value this. We are not given. Sales from Bolu throughout the years was this and this. We are not given. Segun's trade receivable is 1 million. We are not given. Segun did not adjust the parent retained earnings. We were not given. Since you were not given, the best thing to do is to look out for the shares and use that to calculate what will be the consideration. What is the total shares acquired? The total shares acquired is 9 million. 2 for 3 is 6 million. And the share price has been given as 4.8. 80% of 6 million is 4.8. When we calculate for the share, we are having 14,400. 14,400 minus 4.8. This is even share exchange. Something is missing there. They didn't give us the share value, and we're supposed to be given. It's missing because none of the information actually states that. On 1st of January, Segun acquired 80% of equity shares of Bolu, and the consideration satisfied by share exchange of 2 shares for every 3 shares in Bolu. As at the date of acquisition, the consideration satisfied by a share exchange of 2 shares for every 3 shares. 2 shares for every 3 shares give us 6,000. 6,000 multiplied by 6,000 multiplied by what is the market price of Bolu? Market value of 3 naira. At the date of acquisition, shares in Segun had the market value of 3 naira. Then 2 for 3 shares is this. 2 for 3 shares give us that. The nominal value of the shares, equity share, is 10,000, 1 naira each, 9,000. So 9,000, and the share is 70 kobo. All right. So the future value is actually missing from the questions. And I already have that. Sorry, the future value was missing. Let's include that in our questions. The future value is missing. Unlike the first one, go to the one we did earlier, where we were told that I'm promised to pay 1,464,100 on 1st of July 2007. They must give us, without giving it to us, there's error in the question. There's no other ways that we can get that. We have to be given.
But excuse me, sir. What
Yes,
about
sir.
the give us the 27.5? Is that not the cash consideration?
The 27.5.
That's the same cash consideration. 27.5. That's the rate. So
That
on
is the rate.
On what number of the shares are you going to use it to calculate now?
The rate
That's
given to us.
27.5.
The rate given to us will be on the rate of the shares, on the numbers of the shares that was being acquired. But because it is a deferred consideration, okay, we ought to be given the amount of the, we ought to be given the numbers of the shares to actually use that amount for.
That was paid in cash.
Yes.
Okay.
That was what was missing from the questions. Sorry, the reason for this is I just have to bring out the toughest question for us to see, because it won't be nice if you are just solving cheap question and you got to the distance you are having toughest question. That is the reason for bringing out this question, and I've already solved it earlier.
I'm sorry, please, can they bring this question for this level?
Yes, sir.
Because the way I'm looking at the question, even the first one we solved.
Yes.
The first one we solved, sir. It's really a comprehensive question. I know.
The question is for your level. And okay, this was actually extracted from one of the financial reporting questions.
Okay.
No, it's not this thing. Initially, what I adjusted there were all this additional information in order to have the full overview of anything that they might bring. Because you will have a share consideration like this, and you will also have a price. You have a share consideration like this. You have a market price like this. You'll be given statement of financial position like this. You also have statement of comprehensive income like this. But your additional information might not be so tedious like this. That's just the only differences. I added this. I added more additional information. That is why I was looking for where I hide my distance. But actually, Segun also paid a cash consideration of 27.7 kobo, 1 naira each for each acquired shares in Bolu. For each acquired shares in Bolu. For each acquired shares in Bolu. Segun will also pay a cash consideration for each of the acquired shares in Bolu. Wait. What is the share acquired? The share acquired is 2/3 of 9,000, right? Which gives us 6,000.
6,000. Yes.
It gives us 6,000.
And 80% of 6,000.
80% of 6,000 give us what? 4.8.
Give us 4,800.
Give us 4,800. Yes, now. How am I having? I really omitted.
Hello,
Yes,
sir.
sir.
Please,
Yes,
did
sir.
that 3 naira, can we now say that 3 naira minus that 27.5?
That 3
Can
naira
we
much.
go minus that 27.5?
No, if
Which
you
was
add 3
cash
naira.
consideration. 27.5 was cash consideration.
Yes,
Out of the 3 naira. Is it go like that?
Yes. Reason that it cannot go like that is because it's not paying that cash consideration immediately. It is a deferred.
Well, which year will be that? God, they put 20x5. Is it 20x5 or 20x15?
The cash consideration is to 20x5, and we are preparing an account to it's 2015. And we are preparing the account.
The question is,
we are preparing the account in 2014. So it is a year consideration.
Sure.
Actually, I was having a deferred consideration of 7.2 million. Paid. We also pay a cash consideration of 7.2 million of 25.7 kobo on 1st of January 2015. Yes, that is it. Because our future value, sorry.
So where do you get the 7.2?
I went to check the question.
Okay.
I went to
it
check
was omitted from the question.
Yes, it was omitted. Apology.
Okay.
Where our future value is 7.2 million, then our nominal value of the nominal value has already been given as 0.275, which is the 27.5. And we have our rate, our R to be, what is the cost of 10% or 0.10. And our numbers of years is from 2014 to 2015. That is 1 year. So to get the PV, our PV equals to, sorry, because of time, LV plus 1 plus R raised to power what? Minus N. Our future value is 7.2 million of 0.275 multiplied by 1 plus 0.10, we have 1.1 raised to power minus 1. What do we have for the present value? All right. Initially, that is how we do our present value. So the first one is to calculate your group structure. As you can see, Segun Imbolu, the share was acquired on 1st of January 2014. So we have 9 months before the year end. Anything you are doing, you have to multiply it by what? 9 months. I didn't put subsidiaries retained earning, though it is there because I actually merged it here. This is subsidiaries retained earnings. I merge it with that of the parent. Subsidiaries retained earning is here. This is subsidiaries. This is parents. For subsidiaries retained earning, I have my retained earning in the question 3,700 less I want to show us that Yes, this is it. Consideration transferred, the one we just calculated, 14,400. Our deferred consideration, 7.2 million of 0.275 multiplied by 1.1, which gives me 1,800,000. When I added this and this, I have my 16,200. Then we are told that it measured the NCI at fair value. That is for goodwill rather. So for your group structure, you add this. For the subsidiaries retained earning, remember that you are having SOCI, Statement of Comprehensive Income. We are doing it with our Statement of Financial Position. When we are doing our Statement of Comprehensive Income and Statement of Financial Position, at times our consolidation tends to change. Our rules tends to change, though it's still the same thing, but Statement of Profit or Loss actually brings a kind of this thing, a kind of reforms to our questions, to our adjustments rather. I quickly want to run us through it once again. Array. Just go through the slide. We have already done Statement of Profit or Loss and Statement of Financial Position, and you understand well how we actually do the consolidation. Please ensure that you go through them. When you go through them, any area you're having challenges during the midweek, just please drop your question on the chat and let us know. So let's conclude this question because of time. All right. I have my non-controlling interest, which is my NCI. Profit for the year is the profit given in our Statement of Profit or Loss. This is our Statement of Profit or Loss. We have revenue minus cost of sales, give us gross profit. All these things divided, all these things minus expenses, give us profit before tax. Profit before tax minus your income will give us profit for the year, which is profit after tax. Before we now have other comprehensive income. And our other comprehensive income includes gain or loss on evaluation of assets. Then at the end of the day, we are having total comprehensive income of 9,500 and 2,000 respectively. When you are working with your subsidiaries, you just have to first of all calculate the retained earnings for the profit for the year and that of the total comprehensive income. Please go through our previous slide. You will have it there. That's why I have non-controlling interest. As per the question, remember that we are working with 9 months. That's why I'm having multiplied by 9/12. In the question, profit for the year for Bolu. Bolu was acquired. Profit for the year, this profit for the year, 2,000 for Bolu, you multiply it by 9/12. So that's how I have my 2,000 multiplied by 9/12, profit for the year, 10,000. Then my fair value depreciation. If I prepare my subsidiaries net assets, I will have under my goodwill, you have my fair value adjustment, your subsidiaries, NCI calculations. This is my fair value adjustment. At acquisition, I have 4,000. And at the year end, I have 3,900. The differences includes the what? The 100, which I was given at the fair value, as stated in our note. We were told that at the date of acquisition, the fair value of Bolu's assets and liabilities were equal to their carrying amount, with exceptions to Bolu's property. You can see exceptions to Bolu's property, which had a fair value of what? 4 million naira. You go to Bolu's property. Bolu's property. The property was valued at 13,900. How is it now? This is 40 million, no, not 4 million. It's 40 million. That's why we said that for consolidation purposes, which had a fair value of 4 million, had a fair value of 4 million above its carrying amount. So the total property here, instead of giving us 39, it have Bolu's property, instead of giving us 39, it exceeded with extra 4 million. And that 4 million, they said for consolidation purposes, this has led to an increase in depreciation charge of 100,000 naira, led to increase in depreciation charge of 100,000 naira in the post-acquisition period. And Bolu has not incorporated the fair value property increase into its entity. It is that 100 that we called fair value depreciation, because we are told that it makes the fair value to increase by 100. So we have to deduct it. That is the fair value depreciation that we are having there. And there's also another one. We are told that due to the recent adverse publicity concerning Bolu, the goodwill of Bolu will be impaired by what? 500 naira. You have to remove that impairment from it. Goodwill impairment, which is 500. You remove it from it. When you remove it from it, at the end of the day, you'll be having post-acquisition of 900. When you're having post-acquisition of 900, the share of NCR at 20% is this. The same thing you did for profit for the year, you will do for what? Profit, you will do for total comprehensive income. And we are also told that sales from Segun to Bolu, we did, what is it called? We did goods on transit, unrealized profit in the hand of the seller. I said under unrealized profit, identify the seller. Wherever the seller is, just try. If the subsidiaries is the seller, where the subsidiaries is the seller, you have to remove it from the consolidated inventory. But you have to know the way that the goodwill is valued. If goodwill is valued as fair value, as full value method, you have to remove it from the NCI. But if it is valued as proportionate, it will be from the consolidated retained earnings of the parent. Please go through our previous notes in order to check what we discussed under our unrealized profits. And we are told there that to revalue property at fair value, on 30, the increase in Segun property has not been increased. However, a further increase of 600, a further increase of 600 naira in the value of Bolu's property, since its value at acquisition as at 30th, they still have further revaluation increase of 600. Take note of this. We have 500 before, now we have a further additional 600 revaluation. But on 30th, sales from Segun to Bolu, Segun parent, Bolu subsidiary throughout the year had consistently been 300,000 naira per month. Segun made a markup of 25% on this. If you make a markup of 25, markup to margin will be 25 over what? 125. 600 naira at cost to Bolu's inventory had been supplied by Segun in the post-acquisition. They said 600 naira at cost. If it is at cost, it won't be at 125 again. It will be 25 over 100, then multiplied by 600. But if it is unrealized, it will be on the value of sold, on the value of unsold. That is the inventory that remains as at the closing year end. We discussed about it. Please just go through it so that there won't be a kind of confusion. This 600 is revaluation surplus. And revaluation surplus only affects other comprehensive income. To actually check for that, go to your income. You can see gain on revaluation property. Segun 15, Bolu nothing. This gain on revaluation property is the further increase of 600 that they were telling us. This further increase of 600. No, not this one. This one. This further increase of 600 is an upward revaluation in Bolu's property. So we have to take note of that while calculating non-controlling interest. Is that taken? After that, you go to your goodwill. Under your goodwill, you have cost of investment known as consideration transferred. Consideration transferred comprises of the share exchange and cash consideration known as deferred consideration. And we have already calculated that earlier. You know how we arrive at 4.8 for the shares using our listing. That 4.8 shares at the 3 naira, we've already calculated it to give us 14,400. And the deferred consideration is 7.2 million. The 7.2 million that was omitted, where did I put it? 7.2 million naira of 27.5 kobo. That is how we got our 1.8. Addition of the two give us 16.5. Then the fair value of NCI at DOA. The fair value of the shares that remain out of 6,000 shares. Out of 9,000 shares, how many were we able to acquire? We acquired 6,000, which is, we acquired 6,000 and it gives us what? It remained 3,000. That 3,000 that is not acquired, 3,000 multiplied by what is the values of the Bolu shares? Just as we've calculated the first one, it's also the same thing for the second one. Bolu market price of shares is what? 2 naira 50 kobo. Just multiply it by 2 naira 50 kobo. What we have is the values of shares. Look at it. It's also the same way that we have done the first one. That's why I first of all do this first one for us so that we could understand better. This is it, the market value of the shares, which is the market value of the share, 1 million of 0.5. That was the shares that was acquired. They multiply by the market value, they multiply by the percentage. That is how you will also get these subsidiaries of Bolu as well. And that's how I've calculated my 1 million at the 1.8 million shares at 2.50, which give me 4,500. At the end of the day, my purchase consideration is giving me 20,700, less the net assets acquired at fair value. Then at the end of the day, you'll be having your goodwill at acquisition to be 5,700, less your impairment, and the goodwill to be accounted for will be 5,200 naira. After that, do your retained earning. After that, calculate your unwinding interest cost. I've already done that. I have all my calculation here for you. I have all my calculations here for you. Don't bother yourself much. Just go through them. Any aspect that is not clear to you, please just ask me questions so that I can explain them proper. Then I did the purchase of Bolu share and everything. And our intergroup says, I still explain it here, but in our previous class, I've already explained them. That is that on the question. Any question before we go further? Any question before we go further? And while you are consolidating, let me repeat this here. While you are consolidating, the same way you were given your profit or loss is also how you should give them. Revenue. Consolidate the revenue of Bolu and Segun. Remove and add anything therein. Cost of sales. Just follow this trend like this. That is what I've always been advising. And also, that is how I have been able to consolidate. But remember, everything you are doing here, remember that everything you are doing, you just have to anything you are doing, remember that you have to multiply it by 9/12 when it concerns that of the subsidiary. You can't just add directly and you cannot remove directly. All the figure given to you, you have to multiply it by 9/12. Is that taken? So that is how we have gotten my consolidated statement of profit or loss, and also my consolidated statement of financial position. Any questions before we move further? At the end of the day, your account should tally with 73,980 and also 53,980 and also 53,980. Any question before we move further, please? Are we together? Hello?
Hello, sir. I'm hearing you. No problem. We are here. We are with you.
Okay. Please endeavor to go through the questions and endeavor to go through the slide and drop your question where necessary. Likewise,
Okay.
I will also, yes, there was a past question of, I think, 2016, or just check past question of 2016 downward. There's the one that is actually related to that, which is share exchange and cash consideration. Please, Joe, you can attempt that, and I also fish them out for you, and I will send to you as assignment to attempt and for clear understanding. Let's quickly discuss the theoretical aspect of ratio analysis, and we start from that in our next class. Because of time, you have a lot to cover. Let's quickly round up everything so that you can have your time to yourself. Because all this that we're discussing, you still need to go through them. And after going through them, that is when you'll be understanding it better. That's when you'll be able to ask me, how have I gotten my overdraft of 1,700 minus 400? Because when you check it, it's not giving you the same. All right. Ratio analysis is one of the key aspects in financial reporting. And from 2014 to date, it has always been the key question for ICANN. If you can't find it in question 4, in question number 3, you will find it question 4. At times, they tend to bring it to question 2. It's either 2 to 4. You shall find it. Ratio analysis, whether professional level or skills level, you will have your ratio analysis. It now depends on the ratio analysis that will be given. At times, they will give you, they would have prepared some ratios for you, and they will ask you to prepare a counter figures. At times, they give you some ratios that will be prepared. At times, they will give you some ratio you will need to work back in preparation of that ratio. But what we call ratios are why the need for ratio analysis and interpretation. Over the period, company has always been, ratio analysis is useful for, ratio analysis is one of the major tools that we use in analyzing a business and also analyzing projects. It is also one of the key investment ratio, a key investment decision in which the management and the investors used to take strategic decision on a business. It is also useful for organizations to compare the past result with the current result. Organizations also use it to look at the trend analysis that occurs by benchmarking their organization with that of their competitors. All these things that we're saying, what is it per se? Welcome to ratio analysis. I say it's a mathematical representing a mathematical number that is calculated as, forget all those definitions. You don't need it. I can not even ask you for it. But in analyzing a ratio, the first thing you must do is to calculate the ratio using the formula. Then you must have a definition for those ratios that you want to calculate. If I ask you the classification of the ratios, I will know the classification. What does each classes of ratio means? Also, we must be able to differentiate the changes that occur in a ratio. And also, you must be able to recommend on how to improve from the results. Improvement in the result is what actually matters in law. Okay. So, advantage of ratio analysis is it helps to understand the efficacy of decision. It helps us to improve on the past performance, and it also tell us on the area of weaknesses and how an organization needs to improve in them. Second one is that it is helpful in comparative analysis. Like I said earlier, it helps you to compare your past results with your current results. Another point is that it helps in SWOT analysis. It helps an organization. It helps an organization to actually measure their strengths, their weaknesses, their opportunities and threats. That is that. On the limitation, you have a lot. You have a lot. The lot that you have is that it results in a creative accounting, and ratio at times might be misleading. At times, the ratio that you calculated using the formula that you're choosing might be different from the true pictures of that organization. Another thing is that it might be meaningless without a basis of making comparison. If you calculate a figure, let's say for instance now, you calculated the ratio and you got, and the ratio gives you, let's say, you get 2%. If you get 2%, that 2% that you've gotten, what is the effect? There's need for you to analyze that 2%, that the increment was due to so and so as a result of this. Let's say, for instance, you are comparing last year. Let's say our gross profits, we have sales, we have cost of sales. If sales gives us 70, cost of sales now give us 50, then the gross profit we are having is 20. And by the time we less our expenses of 15, we are having a net profit, which is profit for the year, of 5 naira. And when you do your comparison, you are telling me that okay, let's say this one is for 2020. For 2019, I have 50, I have 30, it gives me 20, I have, let's say, I have 10, and I have 10. So let's assume that you are comparing your gross profit. And you are telling me that our sales has improved over the year. Oh, don't let me use like this. 50, let's say this one is 20. It's just a figure. Let's assume that you are not telling us that the gross profit margin gives you, let's assume that the gross profit margin gives us 2%. And you are saying our gross profit has increased from 10 naira, it has increased from 10 naira to 20 naira. if you are telling us the increment that occur, you should be able to relate it in figure, which is 10 minus 10 is 10 naira. It has increased in 2%, which is 10 naira from the previous year. But this is due to the fact that that is what will make your comparison meaningful. It is due. What are the factors that might necessitate the increment in your sales? We will stay there. That is what makes your ratio analysis accurate. Like you're able to tell us that our gross profit has increased from 10 naira to 20 naira, which might due to the sales, which might due to the increment in sales as a result of the following. One, advertisement. If you advertise a product, definitely people will subscribe for you. People will buy that product. By people buying it, remember, the consequence of what you are doing is the expenses, your cost of advertisement. So let's now assume that if you look at the net profit here, the net profit here is 10 naira, and here it's dropped to 5 naira. And you calculate your net profit margin, and you're saying, although the company makes a profit of 20 naira, but at the end, we are having the net profit reduces from 10 naira to 5 naira. What is the major causes of the reduction? That is what we want to know. And that is what will make your ratio analysis meaningful. Otherwise, it is meaningless. That and that and that, as such, and every other one. Then we have differences in accounting policy. If Mr. A is using 30th of September and Mr. B is using the 31st of December, at the end of the day, both of you are using the same year. Both the person that has used month and the person that has used years, you will still arrive at the same conclusion. That is some of the limitation of ratio analysis, because it can be used to measure your performance over a year. You can actually use this to measure a short-term performance, and you can also use it to measure a long-term performance. And that is actually a weakness on that part. But the classification of ratios, initially, I've given you much on classification of ratio here, but to me, ratio can actually be classified basically into 4, and you can classify it into 5. That is also what you are given. Yes, you can classify it as 5 and you can classify it as 4. It depends on you, I repeat. So if you are classifying it by 5, just ensure that at least you know 3 ratios under each of the classes. Let's take, for instance, we have profitability ratio. That is the first one. Initially, you might not use it for your first one. 2, we have liquidity ratio. 3, you have short-term ratios. 4, you have long-term or stability ratio. You can call short time, you can call it instability. Then the 5th one is the investors ratio. I can see somebody asking me, where's my efficiency? You can call it profitability and efficiency ratio. Do we get that? So we have short time, we have the rest. Under liquidity, under profitability, this is what I'm saying. If you are saying profitability ratio, what does that profitability ratio, what does it mean? Liquidity ratio, what does it mean? Efficiency ratio. Efficiency ratio, what does it mean? Long time solvency. You can call this one long time solvency. Or stability ratio. What does it mean? Investors ratio, what does it mean? All these are what you need to know. By knowing them, you have at least, you are giving yourself an edge, and everything has already been stated. The first one is my profitability and efficiency ratio. What does it do? It just measures the performance of an organization given its profitability, given its cash assets to do business. That's why I said profitability ratio are calculated to analyze the earning capacity of the company, giving you your capital base. What is your performance? That is what profitability ratios mean. Giving you your capital base. What is your performance? That is what profitability ratio means. And the first items under it is what we call ROCE, return on capital employed. And this return on capital employed is calculated using profit before interest and tax divided by capital employed. You call it returns. What do you mean by returns? Returns is the earnings. The earnings on your what? The earnings on your investment. That's why you call it returns. Returns means earnings. Capital employed is the net assets. Capital employed is the same thing as a what? Net assets. Capital employed is working capital minus liabilities, which is the same thing as a what? Net assets. Is that taking? So, what are we saying? The return on capital employed measures how management has been effective and efficient in utilization of the what? Resources. The same thing, you can say profitability ratio measures the effectiveness and efficient utilization of resources. Just say profitability. It measures efficient. That's what I like using. Efficient utilization of resources. I have many minutes to eat. You can just improve it on your own. Is that taking? So our ROCE is profit before interest and tax over what? Capital employed. Your capital employed should be equal. Your capital, I didn't put it. Your capital employed is equal to your working capital plus your what? Long-term liabilities or long-term loan. Let me call it long-term liabilities. Or you use your net asset. You now know what you call net asset. Net asset is all what you have in your equities. Ordinary share capital, share premium, like that. General reserves, revaluation surplus, or deficit. All those are what you call your capital employed. Is that taken? If that is taken, then the next one is, you can also have, this is return on capital employed. You can have return on equity. You can have return on total assets. Return on total assets. The first one use this, the return on total assets will give you profit after tax over total assets. Every figure you are getting, you should multiply it by 100. Next is our gross profit margin. When we say gross profit margin, that is just on what is gross profit measured. Margin is your what? Your revenue. You know that. Margin is your profit, your revenue. So just say gross profit over revenue, then multiply it by 100. Everything you are multiplying it by 100. The same thing applicable to net profit margin. It's also net profit over revenue. If you like, you can also calculate operating margin. You just have operating over revenue. Anyhow you like. Just ensure that what you are doing are in lines and you are following what you are doing. Okay. Having said that, we have our net asset. We have our net assets, or what we call capital investment, capital employed turnover, and that one is revenue over net assets or capital employed. You can see I purposely use our net assets here. Having said that, you can also calculate your return on shareholders' equity. For returns on shareholders' equity, it is profit after tax over your total equity. Likewise, having done that, the next one is long-term solvency or stability ratios. But let's do like this. Let's have our ratio analysis. I want to give you the clue to actually stick with. The first one is what? Profitability. Under our profitability ratio, we have gross profit margin, we have gross profit margin, we have net profit margin, we have gross profit, we have net profit, we have ROCE, ROCE is return on capital employed. After ROCE, we have ROE, return on equity. We have our return on equity. After we have our return on equity, the number 2 is liquidity. After profitability comes liquidity. For liquidity, we have current ratio, we have our cash ratio, we have our quick ratio. Don't worry, you can't catch me writing. Those are the 3. We have cash ratio, we have quick ratio. After that, our 3 is our activity ratio. So for our activity ratio, we have our net assets turnover. When we say activities, it measures the numbers of time organization is able to multiply its assets. So we have net assets turnover, we have fixed assets turnover, we have stock turnover, or what you call inventory turnover, we have average day, we have average days, we have receivables turnover, we have receivable pay turnover, we have payable, we have payable turnover. After payable turnover, you can let your, we've done our stock turnover, net asset turnover, fixed asset turnover. There's nothing you want to turn over there again. Just go to the fourth one, which is solvency. I'm combining both short and long time now. For solvency, I have my debt to equity. After my debt to equity, I have my interest cover. Our interest cover. Then that is the major one. If you like, you can now calculate EPS. They can ask you for market price per share. They can ask for dividend per shares. You already have everything in your notes. In our next class, we'll be looking at how to solve all this using a question. Because it is today, the first day that we'll be having is to run us through the group account that we have done so far. And I believe that we would have gone through the readings of my share capital that we are given, my ratio analysis that we are given. Go through them, look at the various ratios that we shall be dealing with. Then I will send you a question before that day so that we will be able to have time to solve more questions more quicker than expected. What I will just implore you to do is go through the questions, and if there's anything, ask questions. Before the day, please go through any instruction or resources given to you via the WhatsApp, because I might likely drop the question that we are going to solve for you. Where I drop the question, please go through it and let us use it as expected. So, any question before we go? Any question, please? Any question before we finally? You have the slide already. Please go through the slide. Okay. Hello. You can unmute yourself and ask questions. You can unmute yourself and ask questions. You can unmute yourself and ask questions. Okay. Where there's no question, kindly endeavor to go through our discussion so far. And while going through it, our next class shall be the concluding part of this diet so that you could have time to go through it. Please endeavor to watch all videos given to you. Endeavor to watch all the videos where we actually solve all the questions. If you're having any question, please feel free to drop your question at any time. I shall be available to attend to all your questions. Thank you for being in the class. Thank you for the attention. Thank you for your time. Wishing you good understanding, sound knowledge, retentive memory, and best of luck in your exam. We have come to the end of the class. So thank you all.